be right. You could make big bucks if you are right, but you always have to look at the risk possibilities. What will happen if you are wrong? So you may want to kind of lighten up, in this situation and not be so many, have so many positions, if you're in fear of the possibility of some kind of a turn. One other point we should make on this particular market, and that is when you see this top here, we have a doji candle. I like doji candle as kind of a signal, maybe at the top. I've said this before, but if you see a doji, it doesn't necessarily mean a top, or if you see a top, it doesn't mean it has to have a doji. But it's just kind of one of those things, the candles, where the traders open the trade at one price, they trade higher, they trade lower, they come back to close to that same price approximately, and that indicates they're pretty uncertain about what the direction will be, and a lot of times that will suggest that maybe we're ready to turn the other way. So combine the doji, combine the fact that we have had a nice run, combine the fact that we are now at a high that was a high a little over a year ago. All those things come together that say, well, maybe this is it. Maybe that trend that we had established, maybe we've been kind of stubborn and hanging on to this long position, and maybe now it is time to protect our profits. We also have a situation where the predicted differences are seeming to suggest that we are going into a weaker period where the momentum is not as strong as it was on, that we had in the past. So now we're looking at a little bit of a different angle. Now the question here, of course, is that, if we were in a situation and, in a situation that appeared to be a top, and we've been long for so long because we've been, convinced we're biased to the buy side and so forth on the U.S. dollar because of the outlook that we've been told about the analysts and the gurus. Now, can you shift gears to become a seller immediately? It's one of the things that traders have to do. You don't want to get locked in too much on one side. You go with what the chart tells you, but sometimes that's a little bit hard to be able to do. But let's say that you have that mentality. You can be that kind of trader, and then on June the 4th, you see you have a candle that extended quite a bit below the predicted low. The predicted low on that day was 88.02, so if you were selling, you'd be selling at 87.52. But we'll say that, because of, the situation where it has gone up, you probably aren't going to be able to shift gears immediately. But on the next day, on this day on June the 10th, when you see that the market, again, this is where it comes to more of an intraday trading approach, where you're watching what is going on and you're seeing the market, previous candle indicated weakness. Now this candle is following through on weakness. So you're probably in a position where you're now going to say, I would like to be short 87.52, and at this particular spot right here, because that's what the charts are telling me that I should do. Okay, 87.52 is now your point, and now you have, same kind of things that you do, but you're doing it now on the downside. 87.52, you think of our 3 points that we would like to have, that we were talking about as our profit target. So that's going to put our profit target at approximately 84.52. If it gets down that far, I may have made that line a little low. Let's correct that one and move it up a little bit higher here. 84.52, somewhere again right in there. Not exact, but you get the idea that if the profit target is reached, if we have a limit order in there to buy, then we're going to take our 3 points and our $3,000 and put it in our pocket. Even if you were looking at this market, you might have said, okay, I have a pretty sharp breakdown here. Again, looking at it, if you are an intraday, watching intraday charts, you might say, okay, there's a predicted low there that we had where we might have added on. The predicted low was 85.86, and so you could sell another contract, add on to it at 85.36. Again, that would assume that you would be looking at this from a standpoint of the intraday trader and watching the flow of trade, and as it occurs, get short. And so now you potentially could have 3 contracts. Depends a little bit on, again, how you would like to look at things. You could have even, if you looked here, even a couple of days later on July 13th, a couple of days ago, you could have even added on another one. by saying that the predicted low was 84.05 and you'd sell at 83.55. You could even have another contract, a nice bunch of contracts, and you have not taken that much risk. Remember, we are limiting our risk to no more than $1,000 on the trade, 50 pips per contract that we're talking about here. So now our current situation is that we are short, according to the strategy, and in terms of taking our profits, we are short at that. We are going to have a stop, our buy stop, because again, the market could turn any time. We know, if looking back, if we were to say, okay, kind of where can the market go? Well, we don't know for sure where it could go, but we know that we have some potential support building, where it might be tough to get through, let's say around 80, 80, 50, somewhere right in there. I'm not using that necessarily as a target, but just as a point at which things could get a little bit tougher, just as they did at the top, to get through that point. So I may change my strategy a little bit, take some profits, when the market approaches there, where I might not doing, if I were doing it a little differently and a different approach, if it were at a different point in time and place on the chart. Now, the stop right now that we have, we're 50 pips above the predicted high for July 15th today. The predicted high today was 84.03. If it's at 84.03, which is this point right in here, we're going to use that kind of as our guideline to set up our protective stop in case the market does turn around, and that would put it at 84.53 right in this right here. This is where our current stop would be if the market should turn, and then we're going to be able to take the profits on the short side, at least on one contract, two contracts, however many you want. It's kind of more of a lightening up type of situation, managing the profits, managing a trade, and then adding to or lightening up as the situation warrants. I'm not sure exactly where the U.S. dollar index went today. I know at one point I noticed that it had dropped to 82.70 on July 15th, and so I'm not quite sure why it dropped so much, or why it has dropped all the way from where it has dropped, but it suits my position fine, so I guess I'm not going to ask a whole lot of questions about what's going on, because when the market's going your way, you kind of just take it, and you don't have to necessarily know exactly why it's doing something to be able to profit from it. Now we're going to kind of summarize, wrap up what we're talking about here with the profit-taking types of techniques. Again, we're talking about a situation where the premise, we have a couple of premises that we have to consider first before we even get into talking about it. The first to make is that we got in to a trend at a good entry point. When we trade in at a good entry point, we had a nice base at which we were able to trade, and since we have a nice base, it gives us some flexibility to do some things as the market moves along. Secondly, the premise is that we had a favorable price move. In the case of the U.S. box, which is common profitable trades, they tend to come